So you get your hands on a company's annual report, and it's easy to just flip straight to the spreadsheets, right? The balance sheets, the income statements. But here's the thing, those numbers only tell you half the story. Today we're going to decode the other half, the narrative that actually gives all that data its real meaning.
Think about it like this. Financial statements are basically a rear-view mirror. They give you a perfectly clear picture of where a company has been. But what they don't do is explain why they hit that bump in the road or why they suddenly took a different exit. And they definitely don't tell you what's coming up ahead.
And that's exactly where the management's discussion and analysis, or just MD&A for short, comes into play. This is the part of the report where the leadership team stops just showing you numbers and starts talking to you, explaining the why behind the what, and giving you a peek into what they see coming down the pike.
All right, so here's our game plan. We're going to cover what the MD&A actually is, look at the 3 big rules the SEC has for it, break down the 4 key parts of its story, and then dive into its most important job, looking toward the future.
So let's get right into it. What exactly is this thing? This story behind all the data?
Well, in a nutshell, the MD&A is a story written by the people at the very top. We're talking the CEO, the CFO, and for any company that's publicly traded, the SEC actually mandates they write it. It's their chance to speak directly to you, the investor, and add some much-needed color to the black and white numbers.
In this quote right here, this nails the whole purpose. The SEC's goal is for you to see the company's performance the exact same way its top leaders do. This isn't supposed to be some generic corporate fluff. It's designed to be a direct window into their strategic thinking. Okay, but to make sure this story is actually useful and not just a sales pitch, the SEC laid out 3 very clear goals that every single MD&A has to hit.
First, it's got to deliver on that through the eyes of management promise. Second, it has to provide real, meaningful context. What was happening in the market? What economic factors were at play? And third, and this one is so important, it has to help you figure out if what happened in the past is a good indicator of what might happen in the future.
So how is an MDA actually built to do all that? Let's take a look under the hood and dissect its 4 main parts.
You can think of these as the 4 main chapters in the financial story a company tells every single year. Each one has a really specific job to do.
It almost always kicks off with the executive overview. Now, technically, this part is optional, but pretty much every serious company includes it. This is the 30,000-foot view, the big picture, where management lays out their main goals, their biggest worries, and the overall strategy. What you're looking for here is a gut check. Does the strategy they're talking about actually line up with the numbers you see later?
Next up is the real heart of the MD&A, the results of operations. This is where management has to explain why the numbers are what they are. They can't just say, hey, revenue went up. They've got to tell you what caused it. Was it a price increase? Did they sell more stuff? Or was it some kind of one-off event? Specificity is everything here.
Then we get to liquidity and capital resources. This section is absolutely mandatory, and for a very good reason. It answers a simple but vital question. Can the company pay its bills? Not just today, but in the future. It breaks down where their cash is coming from and, most importantly, flags any issues that could make it harder to get cash down the road.
And finally, there's critical accounting estimates. This section is all about transparency. It's where management has to reveal the big judgments and assumptions they made when putting the financial statements together. You know, how did they decide what a certain asset was worth? Things like that can have a huge impact on the bottom line, and this is where you can spot if their assumptions seem reasonable or maybe a little too optimistic.
This table, honestly, does a great job of pulling all that together. Just look at that last column, scope. See how some parts are looking back while others are looking forward? The results of operations is mostly historical. It explains what already happened. But the executive overview is almost entirely perspective. It's all about the future. And liquidity and estimates are a mix of both. It's this balance that really makes the MD&A so powerful.
And that focus on the future brings us to our last section. And I would argue it's the single most important and strategic part of the entire MD&A.
This right here isn't a suggestion. It's a flat-out rule from the SEC. Management is required to tell you about any known trend, event, or uncertainty that is reasonably likely to have a real impact on the company's future. Even if it hasn't shown up on a spreadsheet yet, if they know about it, they have to disclose it.
And that one rule completely transforms the MDA. It stops being just a look back at history and becomes a forward-looking risk communication tool. It's management's duty to tell you about the big stuff on the horizon that could seriously change their financial picture.
So if there's one thing you take away from this, it's this. The MD&A is not just an optional recap of what happened. It is a mandatory look into the future, and that is precisely what makes it such an indispensable tool for any serious investor.
All right, let's do a super quick rundown. 1. The MD&A is the story behind the numbers. 2. It's guided by 3 key SEC objectives. 3. It's made up of 4 essential parts. And 4. Its most critical job is to look forward, not just backward.
So I'll leave you with this question. The next time you open up an annual report, are you just going to scan for the numbers, or are you going to take a minute to read the story that management is telling you through their own eyes?